Euro and pound both at major resistance, but one is a fake-out trap, the other a real breakout. Euro to US dollar is showing a hidden bearish divergence I've seen before 300 pip drops. Pound sterling to US dollar has a triangle and a massive institutional flow clash. I've got one scalp and one swing for each, exact levels in the full video. Let me start with a confession. I've been staring at two separate charts all weekend, and they're both screaming one word, resistance. But the way they're screaming is completely different. The euro is testing 1.1600 with a hidden divergence that has fooled me exactly twice in my career. Once it led to a 300 pip drop, the other time it was a false signal that cost me a week of sleepless nights. The pound, on the other hand, is trapped in a tightening triangle, and the institutional flow is showing a clash between the optimists and the hedgers that I haven't seen since the summer of 2023. Today I'm breaking down both pairs side by side, giving you one scalp and one swing for each, with exact levels that I'm personally watching. By the end of this video, you'll know exactly where I'm placing my orders, and more importantly, where I'm staying away. For euro to US dollar, my bias is neutral to bearish within a 1.14401.1600 range, and I will invalidate this view if we see a daily close above 1.1650. I'm not calling a crash, but I am saying that the probability of a rejection at 1.1600 is higher than the market is pricing in. The risk-reward favors the short side at resistance. But I'm also prepared to buy a dip to the lower band. Starting with the weekly, price is at 1.1570, up 41 pips, but the RSI is at 54.1 and trending lower while price makes higher highs. That's the hidden bearish divergence. I've seen this exact formation 3 times in my career. Twice it led to a violent reversal, once it didn't. The tell is whether the MACD crossover confirms or diverges. Right now, the MACD is forming a bullish crossover, which contradicts the RSI. That mixed signal tells me that big players are distributing into strength. The 50-day EMA sits at 1.1536, and price is slightly below it, a sign that short-term momentum is waning. Yet the daily simple moving averages are still flashing strong buy. This tug-of-war between timeframes is exactly what creates choppy, range-bound conditions. I'm not looking for a trend, I'm looking for mean reversion. On the daily, each test of 1.15851.1600 gets sold. The CCI is at plus 112, overbought. Williams percent are at 22.1, overbought. These are not extreme panic levels, but they are enough to suggest that upside is limited without a fresh catalyst. The 4-hour chart shows a series of lower highs, and the pivot at 1.1545 is the line in the sand. A break below that pivot with a 4-hour close would trigger my first scalp short. Conversely, a clean break above 1.1585 would negate the divergence and signal a potential breakout. But I need to see volume and momentum confirmation before I chase. Now, why is this divergence even happening? The dollar softened after last week's 0.1% MOM CPI, and the market is convinced the Fed is done. But the FOMC minutes on Thursday will reveal whether the doves have truly taken over. If the minutes sound more hawkish than expected, we could see a snapback rally in the dollar that sends euro to US dollar down to 1.1450 in a day. What stands out to me is not the CPI number itself, but the 10-year Treasury yield. It's been stuck at 3.8% despite the soft data. That tells me bond traders aren't buying the dovish narrative, and that's where the smart money is watching. So I'm treating the fundamental backdrop as neutral with a hawkish risk, which aligns with my bearish divergence view trade setup. EURUSD Scalp. Short from 1.1600 rejection, I'm looking for a clean rejection at 1.15851.1600 with a bearish 15-minute reversal pattern, pin bar or engulfing. My entry will be on the break below the low of that rejection candle, typically around 1.1575. Stop loss 10 pips above at 1.1590. Target is the weekly pivot at 1.1545. That gives a 30 pip move. Almost equal to 1:3. Invalidation is a close above 1.1600 with momentum, swing, range bound for the swing. I wait for a sweep of the recent high. If price spikes above 1.1585, triggers breakout stops, and then reverses back below 1.1580, that's the classic liquidity grab. I'll short on the break below 1.1580 with a stop at 1.1655, targeting 1.1520 initially, then 1.1440. That's a risk of -75 pips for a reward of 601 for 0 pips. Alternatively, if we see a clean dip to 1.14 for 01.1460, the lower band, I'll buy with a stop at 1.1400, targeting 1.1520 and then 1.1580. This swing setup gives me a clear risk-reward even in a choppy market. Now come to GBPUSD, £4 sterling to US dollar. My bias is cautiously bullish above 1.3479, but I'm not convinced until we clear 1.3550 with conviction. My invalidation is a daily close below 1.3400. The triangle is coiling, and the direction will be decided by Wednesday's UK CPI. I'm positioned to buy a dip to the lower trendline, but I'm also ready to fade a false breakout above 1.3550. Let's start with the COT data. This is my primary edge this week. Asset managers have increased their net GBP longs by nearly 15% in the last 2 weeks. That's retail and institutional speculators piling on. But commercial hedgers, the corporations that actually need to buy and sell sterling for business, have just as aggressively increased their shorts. I've seen this exact divergence before. Back in April 2023, it was the commercial shorts that predicted a 250 pip reversal. So while the chart looks bullish, the smart money is betting on weakness. That's why I'm not blindly buying the breakout. Technically, the daily chart shows a symmetrical triangle with resistance at 1.3546 and support at 1.3479. The ADX is at 24.2, gaining strength, which means we are building energy. RSI at 44.05 recovering, stock at 68.1 neutral bullish, no extremes yet. The 200-day SMA at 1.3434 is acting as a strong floor. The 4-hour trend is bullish. Resumption, and the 1-hour is just consolidating. The key level to watch is 1.3550. A clean break above with a 4-hour close would trigger a squeeze toward 1.3599 and potentially 1.3665. But I'm wary of a fake-out. The UK jobs report on Tuesday and, more importantly, Wednesday's CPI are the real game changers. Consensus expects CPI to rise to 2.9% due to energy caps. If it comes hotter, the bow may have to stay hawkish, and sterling could rip higher. If it misses, the commercial hedgers will have their day, and we could see a sharp drop back to 1.3400. Also, the FOMC minutes on Thursday will influence the dollar side. I'll be watching the release times. The market is likely to trade sideways until Wednesday, then explode. Trade setup, GBPUSD Scalp, triangle breakout long. I'm placing a buy stop at 1.3550, above the resistance, to catch a true breakout. Stop loss at 1.3535, 15 pips. Target is 1.3580, 30 pips. And if momentum continues, 1.3599, 49 pips. That gives a 1:2 to 1 minute and 3.3 seconds. However, if we get a rejection candle at 1.3546, I'll short with a stop above 1.3560, targeting 1.3500, but I prefer the long side because the medium-term trend is bullish. Swing, pullback to support. My highest conviction swing is to wait for a stop run down to the lower triangle boundary near 1.3375, 1.3400. I've seen this happen so many times. The market takes out weak longs, triggers sell stops, and then reverses hard. Once we get that low, I'll look for a bullish reversal pattern, hammer or engulfing, and enter long at 1.3400. Stop at 1.3320, below the major support. Target 1.3550 and then 1.3665. This swing offers a risk of 80 pips for a reward of 150.265 pips. Excellent, The invalidation is a close below 1.3300. Risk management. My personal anecdote with 4 setups on 2 pairs, discipline is everything. I'm risking no more than 0.5% per scalp and 1% per swing, and I never add to a losing position. I learned that the hard way in 2018, when I kept averaging down on euro to US dollar, convinced the pair would reverse. It didn't, and I lost 15% of my account in a week. Now, I cut losses fast and take partial profits at first targets. For this week, I'll also be monitoring correlation. If euro to US dollar and pound sterling to US dollar both move in sync, I'll reduce my exposure because they're both dollar sensitive. Here's the bottom line. Euro to US dollar is a sell near 1.1600 and a buy near 1.1440. The range is your friend. Pound sterling to US dollar is a buy on a dip to 1.3400, but only if we get a bullish reversal, and a breakout scalp above 1.3550 is worth a shot. The FOMC minutes and UK CPI are the wildcards, so keep your stops tight and your position sizes small. I'll be back on Wednesday with a pre-CPI update and a live reaction breakdown. If you want to stay ahead, hit that subscribe button and turn on notifications. And drop a comment below. Which pair are you trading this week, and what's your target? Let's get a conversation going. Trade safe, and I'll see you in the next one.